What's up, everybody? Again, it's Ted here with Bodies and Wicks, your favorite smart money podcast, or smart money technical analysis thing, whatever you want to call it. Anyways, I'm your host, your beloved, talkative, weird guy, Ted. Yeah. Um, and I just did a video on Monero. Right now, we're gonna do a different one on Ethereum. Like I said, I'm gonna start breaking these up. That way, I'm not confusing people by going back and forth or whatever. So, Ethereum was looking good. Was looking good this week, and I can kind of see the pattern in it and what's possibly going to be happening. So, again, this is all about smart money. What is smart money? Well, smart money is about the people who have the means and the ability to control the charts and how you can trade against them. Because they know how you trade. They know how you trade because they're the one that teach you how to trade, right? So, double bottoms, double tops, bear flags, bull flags, trend lines, all that stuff. That is all just made up mumbo jumbo so that you think you think that there is something there, but to believe it or not, charts don't know what triangle bear flags are. They don't know what shapes they're making. They don't know any of that. What they do know is they do know that basically that there is an algorithm, of course, built into these. There's always been an algorithm built into these, except for now it's less man-made and more computerized, as to where prior to it was more man-made, and price goes after two things. It goes after liquidity, right, and it goes after imbalances. So those are the two things it goes after, right? And liquidity would be an example of, let's just say there's an example of two lows, right? People think that those two lows are what would be support, and then so people set their buy limits right at that support level, and then what does it do? It drives way below that support, so that way whoever puts their buy limits in at that level gets completely wiped out, because they either put a short stop loss in or they get faked out and they think it's going to go drop lower, and so they change their direction, and then shortly after, the chart will also change direction and go back up the way it should be. So, uh, these are the kind of things that we talk about in smart money. So, if that's the kind of thing that you're open and willing to wrap your mind around, rather than doing the same old kind of stuff that I keep hearing people do, then what I'd like you to do is do some favors for me. Well, first thing I would like you to do takes nothing but 2 seconds. Go ahead, smash that like button. That would be amazing. Second thing would be to share. And yes, I mean to share. I mean share, 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 share. That would be awesome. Um, and then also, lastly but not least, subscribe, because I will be putting out more and more of these videos. Again, it's Sunday. I try to do a weekly update, and then after that, I will try to Monday. I'll try to follow up to see what's going on and see if we are heading in that right direction. So, without further ado, let's head on over to the charts. So here we are. Here is Ethereum, and I've added a new special graphic here. I got a pointer now, so you can see that I have a little circle here. It's quite fantastic. So now you can see what I'm pointing at and what I'm talking about. It's quite awesome. So we right now I have a 4-hour chart spanning all the way back to early June, right? And as you can see, we did have that big drop off there in early June, going throughout most of June, and then started July. Kind of picked up, fell back down, and then after mid-July, boom, Ethereum took off, started running, and then it looks like it fell back a little bit, and then boom, took off again. Okay, so there's quite a bit to go to unpack here, right? So There's break of structures, multiple break of structures, which is the very very bullish signal. And also there is what is called fallbacks or pullbacks into the smart money buy areas, right? So, and I can probably get rid of some of these Fibonacci's that I had in here beforehand before I started doing this video. And you can see what I have in here is a lot of rectangles. I don't do trend lines unless it's a phantom trend line. So a phantom trend line is really not a trend line. It's there to fake you out, or it's there to make you think that there is a trend line, kind of such as this right here. This would be like a trend line, right? So you see this coming from the bottom here, and it kind of touches here, and it keeps going. So if people think it's going to come over and touch this trend line and then bounce back off, they're usually going to try to buy off of it. But more than likely what's going to happen is it's actually going to go through with it. Going to go through it because, for one, it's already touched the trend line twice. Well, I guess that's what makes a trend line, is basically 2 points that you can put together on a line. It's not really that difficult to put together a trend line, and it's nothing that special either. Hate to tell you, but that's just the way things are. But what has happened, right, within this chart, right? So we did have this little consolidation down here, right? And then after that consolidation, what do we have? We have distribution. And after distribution, we have manipulation, right? After manipulation, we have a distribution. After distribution, accumulation. After accumulation, we will have manipulation. And then after manipulation, we will have distribution. It's the same thing over and over and over again, right? And so what I wanted to do was to kind of show you that since we had, and I thought personally, this is why I drew this big thick line right here. I thought price was probably going to fall back into this area because there was not, especially on the 4-hour, there was not any area for it to fall back into. So it kind of seemed like there was an imbalance there that I thought I could possibly fall into. If I go to the 1 hour, I'm not for sure if it's still there. I don't think so, and I think that's why I left it there. Because I'm still kind of wary about if this is going to fall back into this 1 hour area or not. And if I even go like this, yeah, it did come into this 1 hour gap, right? Okay, so that is a fair value gap. Gap is the difference between basically two candles. So this one would actually span from here to here, but it did drop back into this gap, which we would call an IOFED, right? And so what does IOFED stand for? It stands for institutional order flow. Institutional order flow. I forgot what the ED stands for. Jesus, I'm the worst smart money teacher in the world. It's something delivery, institutional order flow. I forgot what IOFED is, but basically what it means is that once the price pulls back into an imbalance and then it does bust out of it, that is usually a good bullish sign. Is what that means. So that's why IOFEDs are good to look out for. They're good to look out for these types of reasons. Now, that being said, since we did have kind of this consolidation down here, right? And over here, I'm pretty sure you heard me talk about the low, high, lower, low expectation, which meant that there was probably a breaker in here, right? And that breaker probably would have spanned, yeah, the upper portion would have been right through here, right? So it did kind of stay within this breaker being an area that would be considered support and or resistance, one or the other, right? So it did kind of act as support for just a little bit, but it ended up hitting equal highs with another area. So that's when it pulled back into the breaker area and then dropped below it, right? And when it dropped below it, what did it do? It came back down here, hit this area here. It broke even lower than what it was before. So I thought that was a break of structure. I thought it could possibly be going lower than that. I had to wait to see what was going on until I saw this right here. Whenever I saw 1, 2, 3 equal highs, right? To me, what that meant was that was going to be liquidity. Liquidity meaning that the next time it came up to that area, what was going to happen is that everybody was going to put their bets or put their futures or whatever they're going to do, that we're going to sell it short, right? And smart money knows this. Smart money knows that you're going to be selling short on those areas. Why? Because it's already hit it a couple times. You're the person that's been taught, well, if that is resistance, well, then what should you do? You should sell short, right? So that's what it did. And it did it for a very short time. And then as soon as it got done selling short and it got to a comfortable area, what did it do? Boom. Went right back the opposite way and shot right through those highs. And it broke those areas to where people were probably selling short and went right through their sell limits and also right through their stop losses. So it took a lot of their money. And there was probably a lot of people doing that. I don't know if volume is really a good indicator for those kind of things. Let me see if there is a fixed range. Yeah, it's fixed range profile. I want to see what happened in between here and possibly here. Okay, so you can see there was not much happening in here because it just ran right through it. So to me, that means that there's still a big gap right in here. And then right through here is where people had most of their buying and selling happening. And it looked like there was less buying and more selling, which was interesting because then it turned around and took off and went the opposite way. So smart money kind of looked at this and said, okay, I think I know what's going on. Let's trick some people. So that being said, I would like to bring out a Fibonacci, and I'm going to set it right here. And the reason I'm going to set it right there and then put the high right here, well, if it'll go right there. There we go. Is for two reasons. One is because you don't want to always go to the low. That doesn't always make sense. Just because it's the low of a wave doesn't always mean it's going to be the low of the Fibonacci. You want to put it on the last low before it breaks structure, right? And by breaking structure, I mean by these three lines where I put liquidity, right? So it pulls back, hits this low, and then boom, goes up and breaks liquidity. That is where you should start placing your Fibonacci, right? It's not going to go down here. That's not going to make any sense, right? Because that's what a lot of people are going to do. And then they're going to expect it to probably try to come back down to here, and it's not going to hit the 61.8%, right? Instead, if you put it at the last low before it breaks the the um, the liquidity, then you can wait to see if where it's going to end up. It ends up way up here at about 1660, somewhere around in there. And then you see it drop after that. And where does it go to? After I put my Fibonacci in, just below that 61.8%. And it gets in there just low enough to where this is where smart money loaded up. I guarantee you, the smart money probably loaded up on their uh, their their buyings, I guess you could say. And I want to see if we have a good chart to show that. Um, See, it doesn't really show it right through here. I went from down here to over here. Let me see if I can bring that down to about here. Yeah, it doesn't want to show it. It just shows a little bit. Wait. Yeah, it doesn't want to show it for some reason. It doesn't. Yeah, it's not really showing that there's much buying or selling activity in this area. You can see a little bit, but not a whole lot. But that little bit that was in there, that buying activity, that was from definitely from uh, the institutions. You know, whoever may be buying or selling, whether it may be a large pool, whether it could be I don't know, a new financial hedge fund, because the crypto market has made their way into kind of like mixed stocks, with new IRAs and things like that. I don't know if you've heard of Choice or Alto or Delta or things like that, but these are things that have been, or what is it called, domain money. These are kind of things that have your apps have been mixing and matching crypto with uh, stocks and things like that. So uh, that being said, this is the kind of thing I believe that they're kind of looking for, um, kind of going around that same route. Now let me get rid of that. So as you can see, like I said, it dipped down into that 61.8% of the Fibonacci that I drew, right? Not the one that you would draw if you were to put it all the way down at the bottom, because that would make no sense. Because this is just basically a, an area of consolidation. So you don't want to put a Fibonacci at the bottom of an area of consolidation, because that just makes no sense. You want to put the Fibonacci at the bottom of an area right before it breaks through an area of uh, a break of structure, I guess you could say. Yeah, because that's what it is. It's a break of structure. Because then it falls back. It falls back just into the 61.8, and then boom, it takes off again. So now what I can do is I can remove that. And now we're going to do the same thing, because look what happened. It came down to here, and then boom, comes up and then breaks this structure. And what does it do? It hits a bearish order block. Now, what is a bearish order block? That is going to be your last up candle before the next down candle closes below it. Not only that, if we go to the daily, that box that I have should be a daily fair value gap, which means that within a day, from one candle to another, it left a full gap, meaning that from one wick to another, those wicks did not touch. And that's exactly what happened. So you can see it right here. And now we'd like to try to get in a little bit closer just so you can see. So you have here to here. That area right there is a daily order block, or not a daily order block, a daily fair value gap. And because it's a daily fair value gap, there's also a bearish order block. So this is the last area to where smart money decided to buy to try to get, because you can see it consolidated a little bit and made it look like it was going to, you can see it pushes up a little bit, kind of falls back down, and then kind of comes up over here, and then all of a sudden it looks like it could be going back up again, and that is smart money trying to push that up so that retail people will try to buy, right? And then as soon as it gets to a certain point, more than likely it's a bearish order block, another bearish order block, which would, if you want my honest opinion, you have three, right? You have three consecutive green candles right here, right? Those basically act as one candle because the wicks do not exceed the other wick. This middle wick does not. So these act as one candle. So therefore, whenever this comes down and then the smart money people buy as hard as they can so that way other people will chase them, it will come up and it will get as close, if not almost right at the middle, the 50% of those three candles going up, right? And then it did get close. Instead, it got to about the 62%, almost to 62% before it started falling, right? And actually, where it got to, oops, it was probably right there, yeah, right at the bottom of this body of the candle right there. And that could probably be attributed to the 4-hour, to be honest. Now, let me see where we are at in the 4-hour here. Okay, I think I'm farther to the right than where I should be. Okay, here we go. So here you can see all those little 4-hour happenings that are happening, I guess you could say. But it also left a 4-hour fair value gap right in here at the top. And I'm going to get rid of this because that's, well, I guess I don't really have to get rid of that, but I could. But that's the daily fair value gap. And if we just try to measure the 4-hour fair value gaps, here's the two. So these could be important coming up later. Oops. And it looks like they will be. Yep. Maybe not so much the bottom one because it runs right through it, but it does fill it. And that's what one of the things that, like I said, price action does try to do. It does try to fill those imbalances. So it filled that one fairly good and fairly quickly. Here, this one, this 4-hour fair value gap, um, along with the daily, because the top of them both are about the same, it comes up, looks like it has filled the top, comes back down, right? Now it has filled the bottom. So it has filled both the daily, but it still it hasn't completely filled the 4-hour. Well, yeah, it pretty much has, because this one ran up, came back down, and it looks like there was another gap. It even oh no, it didn't fill a gap. It just hit the order block. So there was an order block right in here that it came back down to, hit that, and then that's what made it bounce back up and then try to continue. Now, my thing is that even though there is this consolidation, like I said, the three things are consolidation, manipulation, and then distribution, right? So, next, what we should do would be try to put a Fibonacci down at the bottom here, up to the top of here, right? Ah, it didn't stay. There we go. Hopefully that it didn't stay again. Come on now. There we go. So, and here's the thing. You have a 4-hour fair value gap way down here. Way down here. You have a 4-hour fair value gap, which means that this is a very, very large imbalance that has not come back down to, and it has not been filled. So, my theory, especially regarding smart money theory, is that we're going to see a little bit of a pullback. And we're going to see it come back down into this 4-hour fair value gap. It's also going to try to trick people by making them think that this trend line is that it's going to trade off of it. It's going to come back down. Who knows how long it's going to take for this consolidation to happen. It might even get a little bit higher, to be honest. That wouldn't surprise me at all. If it did get a little bit higher, what I would expect it to get as high as would probably be a previous high, such as this area right here. And I'm going to get rid of this Fibonacci over here because this one doesn't make sense. Okay. So, it would probably be somewhere right along this area right here. So, if we went, oops, hit the wrong button, it's okay. I hate keyboards that don't, I have a Mac, but they always make these keyboards that are suitable for both Mac and Windows, so they always confuse me because I don't have the command button. But let me see. There we go. That's the one I'm looking for. So it wouldn't be surprising if I would see the price actually jump up to here first before pulling back down. Why? Because if it did that, look exactly where the 61.8 is. It's right where this 4-hour fair value gap is. And guess what this area is? This is the area I always talk about. That's called the smart money buy. Why is it called the smart money buy? Because that is the discount price. That's the discount price that smart money looks for because it is a cheaper buy, right? So instead of buying here, right, at whatever percentage this is, probably somewhere around 60-something%, and then hoping it takes off. Instead, what's more than likely going to happen is that the algorithm is going to read this, jump up here, and then fall back down into the smart money buy area, somewhere in between the 61.8 and the 70.5. It may even drop all the way back down to here, which is the 79%. Generally, almost all, when it comes to reversing anyway, almost all of them happen at about the 80% mark. So that's why I always put the 79% to give myself a little bit of leeway if I was to ever give myself a limit. So that way it would enter at the 79%, and then it would come down, hit about the 80. If it did that, that would make complete sense. Why? Because there is one down candle, or bearish candle, I should say, before the next bullish candle takes off and goes above it and breaks the structure, right? that would be considered your bullish order block right there. So I'm going to put plus OB right here, right? Because that is where your bullish order block is in play. Not only that, it would come back down. It would fill the 4-hour fair value gap. And what it would probably do is it would probably spike down really, really quick and hit that bullish order block. So if I can find the, oh, it's in here. No, not that one. It's in the path. Okay. So what I would be thinking is that what's going to happen is that this could consolidate a little bit more. It could fall down, right, into this 4-hour fair value gap. Just touch the top of it, right, to get people thinking, okay, and and manipulate them just a little bit. Manipulate them just a little bit. Make them think, okay, it's going to keep going down. So then they sell with it. And then as soon as they sell with it, boom, it takes off and it goes back up the other way. And then what does it do? It hits this 100% part that I think it could possibly go to. That is going to be equal to this high here. And what that would do, that would create liquidity, right? Or manufactured liquidity, I should say. So let me go ahead and put, well, if it would click on it, manufactured liquidity. Manufactured liquidity meaning that it's not, let me, if it would type, meaning that it is an area that is considered a safe resistance point, right? So if this is considered a safe resistance point, guess what people are going to do? They're going to sell off. Now, at this point, if it's going to sell off, it's going to sell off hard. So I am not for sure if it's going to do that. Instead, what I would think what would happen is that it would actually go up first. And then, so I'm trying to move things around here, go up first and then pull back down really, really hard after that. And then you would fill up the 4-hour fair value gap and then also spike down into this order block, right? And then after that is when you would see the price jump back up. If it'll let me place it there. Okay. So then you could see the price jump back up. It would probably stop somewhere and fill up this fair value gap again. Maybe pull back down. You may have a little bit of a consolidation in this area. Come back up, hit the bottom of that area. Well, didn't mean to do that, but this area right here, that is going to be a bearish order block area. So I'm going to style that red and also make it dotted and text and then put negative OB. Right. So then the price would come back up, probably fill this area right here, come back up, hit it again, and then next thing you know, boom, take off again, and then break those highs. Just like it's been doing all along the way. Run up, pull back, break highs. Consolidate, run up, pull back, break highs. That's what seems like seems to be the pattern for Ethereum right now. So I wouldn't worry too much about it getting too much lower. I think whenever it got down to about 1,000, I think that was a good indicator that that was probably about as low as we're gonna get. Because let's be honest, the economy's not looking too well. I know stocks aren't looking too well, and I think a lot of people are moving everything over to the crypto economy. The only thing that you do have to watch out for is the people that know what they're doing when it comes to smart money, the people that have the institutions, the large sums of money that can control and manipulate the charts. So, uh, that's what I would be thinking. So if it was to jump up and go to this manufactured liquidity line, that price would be somewhere around 1926, 1925, somewhere on where this high is right here, right? So let me see if I can get a number on that. Right? So that high it just says 1918, okay? So 1920, 1925, something like that, right? And if it was to do that, again, if it pulls back just right at that 4-hour fair value gap, at the top of that 4-hour fair value gap is going to be that 61.8%. That is going to be the smart money buy area. This is where smart money is going to want to load up. Okay. Now, the thing is that you also, now it could come all the way back down and hit this right here. But then again, you also have this 4-hour, you know, this down movement that's going all the way down. These are all consecutive down candles, which means that this would be considered all one down movement, which means it would also be considered one bullish order block. So if we pull this over here and style it, let's style it green so we know what we're doing. And then I'll go to text and go to plus OB. That way we know it's a positive order block. Right. Meaning that it doesn't have to come all the way down to this orange line here that I have drawn. It doesn't have to do that. It could just break this area right here, right? So this phantom trend line that everybody thinks it would trade off of, right? Everybody thinks it would trade off that line just because it's a phantom trend line. Instead, break through it just far enough to make people think it would start to go the other way. So then guess what? The regular retail people are going to be doing. They're going to be selling off with it, right? And then all of a sudden it's going to jump up and then it's going to hit that back of that line. And what are you supposed to do at that back of that line as a retail trader? Sell off with it. Now it could sell off with it, and then it could do it, but do it in a very short manner. And what I could see happening is that it kind of be climbing the back of this phantom trend line, making people think, okay, it's going to stay on the back of this trend line, and then all of a sudden, whenever it comes time, boom, it could take off like a wildfire and just run right past where it wants to go. And then either get to the 127 or get up to the of course, the golden ratio, the 167. If it got to the 167, where would that end up at? That would end up, oh my God, directly at pretty much the bearish order block for the next run. So you have, which is your last green candle, right, before your next red candle closes below it. So that is why they call that the bearish order block, because that technically acts as resistance, but it would do it probably for a very short amount of time. I'm going to get rid of, I don't know what this rectangle here is. It's probably old. I'm not going to worry about it. I'm going to add in a new rectangle. And that new rectangle is going to be the 4-hour fair value gap. So it could skyrocket up into here, filling this 4-hour fair value gap, hitting that bearish order block, and then pulling back, right? And then pulling back, and then filling this fair value gap right here. And that would be the sorry, what's the word I'm looking for? That would be the consolidation phase again, right? And then you got the consolidation phase. And I realized you can't see it on my screen. Hold on one second. I'm going to pull it over just a little bit. There you go. So now that you can see it on my screen, this is where the area that I think it's going to go to. And what is that area? That price would be somewhere around 22.90, right? Is where that high would go, right? And that low that it would go to fill that fair value gap would be somewhere around 21.40. So 22.90 to 21.40, somewhere in between there is where I think the next consolidation phase is going to be. Why? If you look up, right? If you look up the market maker buy sell model, so that's what we're going to do right now. So market maker. I forgot to put in buy sell model. Hold on. Buy sell model. There we go. Market maker buy sell model. And then we can go to images. Okay, and then you can kind of see here about what the market maker buy sell model does, right? So you can see that it goes from, if it's going to try to get lower, it's going to go up first before it gets lower. And if it's going to get higher, it's going to be high, then drop lower, and then get higher, right? That's the manipulation part of all this, right? So, oops, wrong one. So if we go to here, right, and we see this area here, that is a box that has already been basically claimed by the market makers, right? So if that oh, come on now. If that box has already been claimed by the market makers, and we'll style that with a yellow line, right? So we know it's the market makers. Yellow would be the market makers, right? It drops down below here. And then, of course, I mean, it looks like it just all falls into place. Because then you got this area right here, which would be your market makers. And then your next area would be right here as a market maker. Okay. And then, of course, your next area would be Boom, right there as another market maker. So as you can see, it goes from here down to here, up to here, up to here. And then, yeah, it could push up to here and then fall back down to here. And if it did fall back down to here, it probably wouldn't stay very long. Why? Because that area has already been claimed, basically by this consolidation area here. So it would come down probably very, very quickly and not stay, not consolidate, not do much. But then all of a sudden, you can see it probably take off and then go back up past this area right here. And then boom, there's your buy model right there for it to get right there. And that's right around 2280, which 2280 would be a uh, institutional buying point or an institutional level. Anything that with 20, 50, 80, 200, 500, 800, 0, anything with zero in it as well. Those are considered smart money institutional levels. So if it came all the way up to 22,800, that would make perfect sense. And then now your buy, your market maker buy level, your market maker buy model has been completed, right? If we go back to, if we look at that as a whole, you see this, this, and then this, right? Isn't that similar to what we see here? This, and then up here in this. So that's what I am looking at whenever I am looking at Ethereum. See if there's any other good examples of the market maker buy model. Don't think so. See, here's one of the sell model where they think it's going to go down here. I'm not seeing one of the buy model. So either way, this chart that I'm showing you is coming specifically from my mentor, which is Inner Circle Trader, which is why I'm showing you this, because this is what I believe is going to be happening with Ethereum. So be careful. Again, this is all just speculation. This is not financial advice. This is just through my lived experience. I was taught all of this information on the Forex market and on the indices futures markets. Nothing of this was brought to me on crypto. I have just been applying these same principles on crypto, and it has been working. So that should be about it about Ethereum. So hopefully that was enough for you to understand what is going on and understand what could be happening next. So thank you very much for watching this video, and I will hopefully see you in the next one. That should probably be Bitcoin. Between now and then, happy trading.